For the first time in modern history, America is living inside two completely different economies, one exploding upward on liquidity, leverage, and speculation, and the other sinking under the full weight of stagnation, unaffordability, and financial exhaustion. Wall Street is breaking records while households break under pressure. Markets soar as real incomes fall. Corporate profits reach historic highs while savings collapse to levels last seen in crisis years. This isn't a cycle. It's a split, deep, structural, and mathematically impossible to sustain. And when two economies can no longer coexist, one must violently correct. A once-in-a-lifetime economic reset is already forming. Something extraordinary is happening in the American economy, something so stark, so mathematically unsustainable, that economists are calling it the widest divergence between financial markets and everyday life in modern history. On one side sits Wall Street, giddy with optimism as the S&P 500 pushes into record territory. Investor sentiment is soaring, margin debt has blown past previous peaks, and corporations are artificially propping up their own valuations through some of the largest stock buyback programs ever recorded. To the financial world, the future looks bright, stable, and full of upside. But step outside the trading floor, and the picture changes instantly. Main Street is drowning. Household savings have collapsed to multi-decade lows. Inflation on essentials, rent, groceries, utilities, transportation, continues rising faster than wages. Credit card interest rates have smashed through historic records, trapping families in a cycle of monthly minimum payments while balances explode. More than 60% of households now live paycheck to paycheck, even among those earning middle and upper middle class incomes. It is not a recession on paper, but it feels like one in every kitchen, every gas station, every neighborhood grocery store. The disconnect is not a temporary anomaly. It is structural. Wall Street is buoyed by financial engineering and liquidity saturation, while Main Street is battered by decades of wage stagnation, cost of living inflation, and diminishing purchasing power. Markets are functioning like a sealed bubble, drifting upward on expectations and algorithms, while real life sinks under the weight of financial strain. The two lines, one pointing sharply up, the other sloping steadily down, were never meant to diverge this far. History shows that when financial valuations detach from economic fundamentals, correction is not optional, it is inevitable. And that is the warning flashing beneath the surface. The illusion can continue for a while, but not indefinitely. At some point, the fantasy of prosperity in the markets must collide with the reality of household despair. The two economies cannot drift apart forever without consequences. For more than 6 decades, Americans could rely on one constant: real income growth. Adjusted for inflation, the average wage grew at roughly 2.8% per year from the post-war era through the early 2000s. That steady upward trajectory formed the backbone of the American dream, supporting homeownership, savings, mobility, and the belief that each generation would live better than the last. But something snapped after 2008. The global financial crisis didn't just wipe out wealth, it derailed the stable growth trend that had shaped American life for generations. Real incomes never fully recovered. They flatlined for a decade, then collapsed outright. If incomes had continued rising at their historical 2.8% trend, the typical American worker today would be earning tens of thousands more per year. Instead, the gap between what people should be earning and what they actually earn has widened into the largest earnings shortfall in modern history. The picture grew even darker after 2021, when inflation surged at the fastest pace in 40 years. Real incomes turned sharply negative, meaning wages were not just stagnating, they were actively shrinking. Every month, households lost purchasing power, buying less with each paycheck than they did the year before. This collapse does more than squeeze budgets. It undermines the psychological and economic stability of families through what economists call permanent income theory. People don't spend based on today's paycheck alone, they spend based on what they expect to earn in the future. When future expectations fall, behavior changes, savings vanish, investment drops, homeownership becomes out of reach, and long-term planning collapses. A shrinking future forces families into survival mode. That shift is now happening nationwide. Real income decline is not a blip, it is becoming permanent. And as the earnings trajectory resets lower, it sets the stage for something far more profound: a permanently reduced standard of living for the American middle class. The backbone of prosperity didn't bend, it broke. Over the past 4 decades, the American economy has undergone a transformation so profound that it silently rewrote the balance of who benefits from progress. Worker productivity, the measure of how much value each employee generates per hour, has surged more than 70%. That should have ushered in a new era of shared prosperity. Historically, whenever productivity rose, wages followed. That link defined the post-war boom and created the broad, stable middle class the US became known for. But beginning in the late 1970s and accelerating in the 2000s, that relationship fractured. Compensation rose only about 18% over the same period. The gap is not a minor deviation, it is a structural rupture. Automation and technology played a pivotal role. As software, robotics, and digitization made workers vastly more efficient, the value created didn't flow back to them, it flowed upward. Corporate restructuring concentrated power in executive suites and shareholder boards. Outsourcing and cost-cutting turned labor into a variable expense to be minimized rather than a partner in growth. Every incremental improvement in efficiency enriched capital, not labor. This created an unprecedented transfer of economic output from wages to profits, widening the value capture gap with each passing year. That shift hasn't just deepened inequality, it has fundamentally weakened economic resilience. When the majority of citizens generate more value but receive a shrinking share of it, household buffers erode. Savings disappear, emergency funds evaporate, and financial shocks hit harder. The system becomes top-heavy, dependent on asset owners for investment and growth while hollowing out the consumer base that sustains the real economy. This misalignment creates national fragility, a country where productivity soars on paper but living standards stagnate in reality. The efficiency gap is not simply an economic statistic, it's a blueprint for instability. A system that rewards the machines and capital owners while sidelining the workers who enable the system ultimately undermines itself. The model can function for a while, but not indefinitely, because no economy can thrive when its labor force grows more productive and simultaneously more economically insecure. Since the 2008 financial crisis, America has lived through one of the most explosive asset booms in modern history, a supercycle fueled not by organic economic strength but by unprecedented monetary engineering. Near-zero interest rates, massive quantitative easing, and trillions in liquidity injections didn't just stabilize the system, they inflated financial markets far beyond their underlying fundamentals. Stocks, bonds, housing, everything tied to capital rather than labor, ballooned in value. The S&P 500, even adjusted for inflation, has surged more than 300% since 2009, while real income growth over the same period barely cracked 50%. The wealth gap didn't widen by accident, it widened because the system was designed to lift asset prices at all costs. Cheap money made borrowing effortless for corporations and investors, triggering a feedback loop where rising prices encouraged more speculation, more leverage, and more investment into assets rather than productive capacity. Meanwhile, wage earners, whose incomes grew sluggishly, could not meaningfully participate in the boom. Asset owners multiplied wealth geometrically through compounding returns, while those without assets fell further behind each year. Instead of prosperity rising from innovation, productivity, and wage growth, prosperity became defined by financial inflation, a tide that lifted only the boats already floating in the harbor. But this super cycle carries a mathematical expiration date. You cannot inflate assets indefinitely without disconnecting them from the real economy that supports their value. When monetary policy reverses, whether through higher rates, reduced liquidity, or tightening credit, the artificial support under asset prices weakens. Valuations start to normalize, leverage unwinds, and the wealth illusion evaporates. The same mechanics that drove prices up can drive them down even faster. This is the inherent risk: the system replaced real prosperity with artificially boosted valuations. Sooner or later, markets will be forced to reconcile with fundamentals: income, productivity, demand, and real economic output. When that reconciliation comes, the asset supercycle won't simply slow down. It will break, and the consequences will be felt far beyond Wall Street, reverberating through every household caught outside the bubble. America's financial foundation once rested on a simple but powerful buffer: household savings. Through the 1980s and early 1990s, the typical American saved between 12% and 13% of their income, giving families a built-in shock absorber against job loss, medical bills, recessions, unexpected life emergencies. That cushion didn't just protect individuals, it stabilized the entire economy. But over the past 4 decades, that safety net has thinned dramatically. Today, the national savings rate hovers under 4%, and in many recent months it has dipped even lower. The steady erosion has left households exposed, brittle, and vulnerable in ways unseen in modern history. Part of the decline stems from a broader structural shift. As corporations became more profitable, efficient, and cash-rich, households moved in the opposite direction. Companies accumulated record reserves, engaged in buybacks, and expanded balance sheets, while families, facing stagnating wages and rising costs, were forced to rely on debt rather than savings to fill the gap. Credit card balances have surged to all-time highs, now exceeding $1 trillion. Interest rates on those balances have hit record levels, pushing average consumers into a debt treadmill where monthly payments barely cover interest. Delinquency rates are climbing at the fastest pace since the Great Recession, and surveys show that nearly half of Americans cannot handle an unexpected $500 expense. Emergency funds, once considered a cornerstone of financial stability, have all but disappeared. A majority of households have less than 1 month of savings, and millions have none at all. This is not merely a personal finance problem, it is a systemic economic risk. An economy where households live this close to the edge cannot absorb even minor disruptions. A small increase in rent, a modest rise in utility costs, a brief lapse in employment, or a single medical bill can spiral into eviction, bankruptcy, or long-term financial damage. The country has lost its shock absorber. And when an entire population becomes financially thin, fragility spreads through the system. One unexpected event, economic, geopolitical, or social, can cascade into a national crisis because the households meant to absorb stress are already exhausted. For generations, housing served as the gateway to stability, wealth creation, and community. But over the past 2 decades, it has transformed into the country's most punishing financial choke point. Historically, homes cost about 4 times the median household income, a manageable ratio that allowed families to buy without sacrificing their future. Today, the national multiple has surged to nearly 7 times income, a shift so dramatic it has redefined what the average American can afford. Housing hasn't just become expensive, it has become structurally unattainable. This strain is compounded by a brutal dual pressure. Home prices have skyrocketed to record levels while mortgage rates have doubled from their pandemic lows, creating the highest affordability barrier in modern U.S. history. A home that was accessible at 3% interest becomes completely unreachable at 7%. Buyers face the worst of both worlds, inflated prices and crushing borrowing costs. Meanwhile, renters are trapped in their own version of the crisis. Rent inflation has surged across the country, vacancy rates have fallen to multi-decade lows, and shelter costs have grown so large that they now account for the biggest portion of the consumer price index. For many families, housing now consumes half, or even more, of their monthly income. But the story goes deeper. Institutional investors have entered the housing market at unprecedented scale, buying single-family homes not as places for people to live, but as yield-producing assets. This shift has distorted supply, driven bidding wars, and converted entire neighborhoods from ownership communities into rental empires. When homes become financial instruments rather than shelter, the market stops serving families and begins serving portfolios. Housing is no longer just an economic sector, it is the fuse running toward the next reset. When shelter becomes the primary financial pressure point for tens of millions, the consequences ripple through every corner of the economy. Consumption drops, mobility shrinks, family formation weakens, and inequality deepens. In a system this stretched, housing doesn't just reflect economic strain, it ignites it. For most of the 20th century, America's greatest asset wasn't its GDP, its military strength, or even its technological innovation, it was its belief. The conviction that each generation would live better than the last fueled ambition, stability, and national cohesion. In the 1950s, 60s, and 70s, more than 75% of Americans confidently expected a better life for their children. Today, that number has collapsed to just 25%. This isn't simply pessimism, it is a psychological breakdown at the center of the national identity. Housing costs, stagnant wages, and relentless inflation on essentials have done more than strain budgets, they have reshaped the way Americans think about the future. When young adults delay milestones like marriage, homeownership, and starting families, it reflects more than personal choice. It reveals a collective recognition that the economic runway is shrinking. Adulthood itself has been postponed, with multi-generational households now at their highest levels since the Great Depression. Parents aren't just offering support, they are serving as economic lifelines because their children cannot afford to launch independently. Retirement expectations have deteriorated just as sharply. Millions now assume they will work until they physically cannot, with little hope of financial security in old age. Savings gaps, disappearing pensions, and volatile markets have created a generation preparing for permanent precarity rather than stability. Long-term planning, once a cornerstone of middle-class confidence, has been replaced by short-term survival. This shift creates a dangerous feedback loop. When people stop believing in upward mobility, they reduce investment in education, decline to start businesses, avoid risk, and lose faith in institutions. Economic pessimism becomes self-reinforcing, weakening the social fabric from within. A nation that no longer trusts the promise of the future becomes politically volatile, culturally fragmented, and economically stagnant. The consequences are far-reaching. When optimism collapses, mobility collapses. And when mobility collapses, the system begins to destabilize, not from external shocks, but from the erosion of its own belief structure. The United States has returned to a level of wealth concentration not seen since the eve of the Great Depression. The top 0.1%, a tiny fraction of the population, now holds more wealth than the bottom 80% combined. This is not an abstract statistic, it is a structural transformation in how the economy distributes the value it creates. And it mirrors, almost precisely, the dynamics of the late 1920s, a towering concentration of capital at the top and a hollowed-out economic base beneath it. This concentration didn't emerge randomly. It was engineered through decades of asset inflation driven by low interest rates, quantitative easing, and financialization, all of which disproportionately boosted the portfolios of wealthy households. Preferential tax structures, capital gains rates lower than income tax, inheritance loopholes, and corporate-friendly legislation accelerated the divergence. Meanwhile, private equity, venture capital, and exclusive investment vehicles generated returns unavailable to ordinary families, creating a compounding advantage where wealth begets more wealth at an exponential rate. As capital accumulated at the top, its relationship with the real economy weakened. Investment flowed into financial assets, derivatives, share buybacks, and speculative ventures rather than wage growth, productivity improvements, or broad-based prosperity. The result is a bifurcated system where capital soared upward while the economic ground supporting it became increasingly unstable. Such concentration carries systemic risks. Historically, when wealth pools heavily among a small elite, political polarization intensifies, institutional trust collapses, and social mobility plummets. Citizens begin to view the system as rigged because the system is rigged. The political sphere fractures, populist movements surge, and economic shocks hit harder because the bottom of the distribution has no cushion. The parallels to the late 1920s are not metaphorical, they are structural. A society cannot sustain stability when such an extreme share of its wealth is siloed among so few. When capital leaves the real economy behind, it doesn't merely reshape inequality, it sets the stage for the next major rupture. The American economy today resembles a finely stacked layer cake of fragility, where each weakness compounds the next, creating a structure that looks stable from a distance but wobbles under its own weight. At the base sits the long-term collapse of real incomes, once the engine of broad prosperity, now sputtering as wages fail to keep pace with costs. Layered on top of that is the relentless rise of essential expenses, housing, healthcare, education, and transportation. As spending necessities grow faster than earnings, households find themselves squeezed tighter every year, leaving little room for savings or investment. The next layer is the erosion of household financial resilience. With savings rates at historic lows and credit card balances at historic highs, families rely on debt to fill even routine gaps. Delinquencies rise, emergency funds evaporate, and the margin for error disappears. These household pressures elevate the stakes of every economic fluctuation. A minor interest rate hike, a small rise in rent, or a temporary job loss can trigger cascading financial consequences. Above that lies the distortive layer of inflated asset prices, stocks, bonds, and housing markets buoyed not by fundamentals but by decades of cheap money and liquidity injections. These inflated valuations enrich asset holders and drain mobility from the rest, creating a structural imbalance where the wealthy soar while the majority stagnates. Concentrated wealth, now at levels comparable to 1929, forms the final and most dangerous layer, shaping policy, influencing markets, and amplifying inequality to a degree the system cannot absorb indefinitely. The psychological layer binds it all together. With optimism collapsing and long-term expectations shattered, consumers behave defensively, reducing risk-taking, spending, and investment. Confidence, one of the economy's invisible stabilizers, drains away, weakening the system from within. Policy makers face an impossible dilemma: any intervention that strengthens one layer destabilizes another. Stimulus inflates assets. Rate hikes crush consumers. Liquidity protects markets but erodes real purchasing power. The result is an economy stretched far beyond what demographics, wages, and household savings can support. This is the fragility layer cake, engineered piece by piece, and now trembling as each layer multiplies the instability of the one beneath it. Prosperity built on parallel economies is an illusion. When markets float far above what demographics, wages, and productivity can support, gravity eventually takes over. America is nearing that moment of reckoning, a point where reality asserts itself, and the system must reset to something sustainable, whether by design or by collapse.